We're diving into the world of mutual funds, a cornerstone of modern investing. Whether you're a beginner or an economic student, this video will give you a comprehensive understanding of mutual funds, their types, advantages, and how you can get started. Let's begin our journey to financial literacy and empowerment. The video is for educational and entertainment purposes only. It is not financial advice. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of securities. These can include stocks, bonds, money market instruments, and other assets. The concept of mutual funds is widely used in the United States, Canada, and India, but similar structures exist globally. There are various types of mutual funds, including open-end funds, closed-end funds, and unit investment trusts. Each type has unique characteristics and advantages. Today, we'll focus primarily on open-end funds, the most common type. Mutual funds can be classified based on their principal investments. Let's explore the main categories. These invest in short-term, high-quality debt securities. They aim to provide liquidity and preserve capital. These invest in bonds and other debt instruments. They provide regular income and can vary in risk based on the credit quality and maturity of the bonds. These invest in stocks and aim for capital appreciation. They can focus on specific sectors, regions, or investment styles. These invest in a mix of stocks, bonds, and other assets. They offer a balanced approach to risk and return. Additionally, mutual funds can be either index funds or actively managed funds. Index funds track the performance of a specific market index, while actively managed funds seek to outperform the index, but usually come with higher fees. Investing in mutual funds offers several advantages. Mutual funds invest in a wide variety of securities, reducing the impact of any single investment's poor performance. Portfolio managers use their expertise to make investment decisions on behalf of investors. Investors can buy or sell mutual fund shares at the end of each trading day at the fund's net asset value (NAV). Pooling resources can reduce transaction costs and other expenses. Mutual funds are regulated by government bodies, providing a level of oversight and protection. However, mutual funds also have some disadvantages. There are fees and expenses. These can include management fees, distribution charges, and transaction fees, which can erode returns. Investors have little control over the specific securities in the fund's portfolio. Capital gains. Distributions are subject to taxes, which can create liabilities even if the investor has not sold any shares. Actively managed funds may not consistently outperform their benchmark indices. The concept of pooling investments dates back to the 18th century. The first modern investment fund was established in the Dutch Republic in response to the financial crisis of 1772 to 1773. In the United States, the Boston Personal Property Trust, founded in 1893, was one of the earliest similar structures. Continuing, the development of open-end funds began with the Massachusetts Investors Trust in 1924, which is still in existence today. Regulatory changes following the Wall Street crash of 1929, including the Securities Act of 1933 and the Investment Company Act of 1940, further shaped the mutual fund industry. Choosing the right mutual fund involves several key considerations. Compare expense ratios and consider lower-cost options like index funds or ETFs. Compare a fund's performance against its benchmark and peer group, and consider the consistency of returns. Understand your risk tolerance and investment objectives. Diversify your investments across different asset classes. This legal document provides detailed information about the fund's investment objectives, strategies, fees, and performance. Consider the tax implications of distributions and how they fit into your overall tax strategy. Mutual funds are regulated to protect investors. In the United States, the SEC oversees mutual funds under several key laws, including the Securities Act of 1933 and the Investment Company Act of 1940. In the European Union, mutual funds are regulated under the UCITS directive, allowing them to be sold across member states. Canada, Hong Kong, Taiwan, and India also have their own regulatory frameworks, ensuring investor protection and market integrity. Ready to start investing in mutual funds? Here's a step-by-step guide. Determine your investment goals. Are you saving for retirement, a major purchase, or another financial goal? Assess your risk tolerance. Understand how much risk you're willing to take and choose funds that match your risk profile. Research funds. Use tools and resources to compare different mutual funds based on performance, fees, and other factors. Open an account. You can invest in mutual funds through brokerage accounts, retirement accounts, or directly with mutual fund companies. Monitor your investments. Regularly review your portfolio and make adjustments as needed to stay on track with your goals. Mutual funds are a powerful tool for building wealth and achieving financial goals. By understanding the different types of mutual funds, their advantages and disadvantages, and how to choose the right ones for you, you can make informed investment decisions. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.